Warm welcome to all of you. Today's webinar number is 137. And we are taking this webinar after a long time, probably after 4 weeks. So the topic is how to outperform inflation. Estimated time is about 30 to 40 minutes. So first is the inflation and interest rates. And I'm very sure, being an investor, you all know what is the interrelationship between these two parameters. Basically, very low interest rates or high level of cash present in the economy are the reasons for high inflation. It is but very natural. If you keep the interest rates very, very low, then people will borrow money and buy the goods and services, buy the house, buy the automobiles and everything, whatever they can. And this leads to a rush for the goods and services, which in turn leads to inflation in most of the cases because the supply side is not as strong as the demand. And another reason can be a high level of cash in the economy, as what happened post-COVID, especially in developed countries. A lot of money, a lot of currency was printed. And that is one of the key reasons for high inflation in most of these countries, added with the Russia-Ukraine war. And there are many other reasons for the present high inflation. To cool down this high inflation, central banks around the world, they increase the interest rates so that the money available in the market is reduced, so that people should restrict their demands, and this leads to slowdown in economy and also slowdown in the inflation rate. Very high interest rates lead to slowdown in the economy, as we have already discussed. So basically, there is a kind of a vicious circle. If you try to tame inflation, then the economy suffers. And this is what is happening in most of the countries around the world. Because in some or the other way, we are interlinked. That is why the heat is being fed by even other countries also who have not printed the currency, like our country, India. So instead of printing the currency, what we have done is we have distributed the food and grocery to the deserving people. And that is one of the reasons why we are better placed today compared to other developed countries. So there is the inflation. The darker the color, more the inflation. So here we are at India. Here it is India. It is about 7%. This is Russia. This is about 14%. And as you can see, there are many, many countries like this. US around 8%. There are many other countries. Those who are interested, they can visit tradingeconomics.com, and there they can search for inflation, and there they will get this type of chart. Now, this is the inflation rate during last 10 years in India. So inflation rate about 10 years back, it was around 10% to 12%, which fell down to sub 2% levels during 17-18, and then it started rising up. Presently, it is at around 7%. So this is how the trajectory has been for the inflation. More or less, it is stable presently around between 6 to 8%. Nevertheless, yes, it is higher compared to around 4%, which was hovering in the 18s and 19s and even in 2017. So this was all about the Indian inflation rate. Now this blue color is the Indian inflation rate. the chart which I have shown you just in the previous slide, and this scale is on the left side. Now this dotted line is a chart for US inflation rate, and this scale is plotted on the right side. So as you can see, 10 years back, US inflation rate was hovering around 4%, which came down to almost zero, and then around 2%, 2%, and then from 2021, it has shoot up, and presently it is around 8%, right? And the Indian inflation rate is around 7%. For India, don't see this scale. For India, this is the scale on left side. For US, the scale is on right side. So if you go by the trajectory, then you will find that after 2020, that is post-COVID, the inflation rate in US has shoot up from almost 0% to 8%, while in India, it was around 6% post-COVID, and now it is around 8%, 7%. So in our country, not much hike in inflation rate, but when compared to US, yes, we are doing very well. Similar chart for UK. For UK also more or less the same, but the present rate of inflation in UK is very, very high at 10%. So it is extremely high, and the story is almost more or less as in case of US, but the shape is almost more or less the same, but the absolute rate of inflation is very, very high. And this in China. China was hovering around very low levels of 2%, and it is still managing at around 2 to 3%. Of course, in China, there is extreme slowdown presently. Rate of interests are also very, very low. In fact, the Chinese government is further lowering the rate of interest so as to prop up the economy. So this was all about the inflation, because high inflation is not good for the economy, and that is reflected in the stock prices also. Sooner or later, stock market follows the economic fundamentals. Now, this is a chart for last 5 years. As you can see, this blue color is BSE Sensex. This green color is Dow Jones Industrial Average, and this for USA, and orange is for France, and yellow one is for UK. So as you can see, India has performed much, much better compared to these countries. It is 80% up. The Sensex is 80% up during last 5 years. Here is the chart. And Dow Jones Industrial Average is up by 26%. FTSE, that is UK, is down by 8.36%, and France is up by 7.51%. Once again, a clear outperformance by Indian stock market. Now we are going for a poll. It's a very simple question, but may find it difficult to answer. Will Indian economy continue to perform better than other countries in the foreseeable future? So there is an option to cast your kind of a vote, and I request all of you to participate. It is very difficult to predict, but I am saying that foreseeable future. So nothing wrong based on the foreseeable future only. You invest in medium-term stocks. So 78% of the participants have voted. Still 22% left, and the results are unidirectional. I was not expecting such kind of results. So there is no one who says no. 94% of the participants say that yes, in the foreseeable future, yes, Indian economy will continue to perform well. Thank you. Thank you for your valuable vote and time. Presently, India is in a very sweet spot, and India GDP is only 4% of the total world GDP, out of which USA commands 24%, Europe 24%, Japan 6%, China 15%, and rest of the world 27%. So, considering that most of these countries worldwide are passing through much higher inflation than India, there is a kind of a recession already. Some of the countries have already declared that yes, we are going into a recession, and soon other countries may also go into recession. Recession means negative rate of growth in economy. In that case, there will be lesser demand for the commodities, and that bodes well for India as well as China. China is passing through its own issues. So India, with only 4% of the GDP compared to the whole global scenario, there will be lots of commodities available at much cheaper prices. Already, commodity prices are falling, and that bodes well for India. So at least for the foreseeable future, yes, the prospects are good. These are the GST collections. As you can see, it is pretty stable, and from last 5 months, it is above 1.4 lakh crores. Even for the month of September 2022, that is last month, it was 1.48 lakh crores. This also shows that, of course, the second quarter results are going to be pretty good. Of course, part of this, maybe very small, part of this credit also goes to the high inflation. One more poll. How long it may take for the US economy stock indices to regain to the historic high? US economy was at historic high during, I believe, January or February this year, 2022, and presently it is pretty down about 20-25%. So what do you believe? Just a rough guess. I know it is extremely difficult, but just a rough guess. How much time it will take for the US economy to come back and surpass the previous peak made by Dow Jones Industrial Average? 1 year, 2 years, 3 years, or more than 4 years? So option is available on your screen. Now you can participate. I'm looking for more and more participants to cast their votes. Yes. So this time we are 79%. Last time 78% participants have participated. Okay, we are closing. So it has gone to 81%. We are closing this poll. Here are the results. 23% said 1 year, 43% said 2 years, 26% said 3 years, and 9% said more than 4 years. So 91% of the people say that within 3 years, the problems will be resolved. Okay, thanks for sharing your views. So 91% people, participants have said that it may take up to 3 years for the US economy to come back to its high made during January, February. Okay, now I will show you an interesting data. This Alphabet Incorporation, that means Google, Class A, there is a category like class A, class B, class C in US, not for all stocks, but for some stocks. And that differentiates them in respect to the voting rights. So the topmost class is class A. Google was quoting at 151 US dollar during 52-week high. Current price is 95. Decline is 37%. Meta platform is Facebook. It is down by 62%. Amazon is down by 40%. And Zoom, the platform which we are using presently, is down by 75%. Now, if you believe, as you said, 91% of you people said that within 3 years, US economy will reach to the historic high. So in that case, can we not buy these shares at the current price? Because within 3 years, if you can get back to the previous high, then what kind of returns you will get? So if you believe, once again, within 3 years, you can expect 59% returns in Google, Meta platforms 161%, Amazon 66%, and Zoom 293%. Are you ready to buy? Are you ready to buy these shares? Irrespective of what is going to happen tomorrow. Yes, because what we have considered is 3 years of investment horizon. That is how you should look for the long-term investment. Don't think what is going to happen tomorrow, what is going to happen day after tomorrow, what Fed is going to decide, what RBI is saying. All these things will keep on moving. And slowly turnaround will come and you will not be able to judge, yes, it is the bottom. So don't look for the bottom. If you are convinced in these stocks, yes, you can buy. It is just, you only said that within 3 years. So are 161% returns not good from 3 years perspective? Even the lowest, that is the 59% returns, are pretty good. Of course, I am assuming that these shares will reach to their 52-week high. In case of Zoom, it may not be possible because Zoom was booming just because of the COVID. Of course, in 2022, not to that extent, but still, you have got good opportunity to make a killing, isn't it? This is not I am saying, this you are saying, that within 3 years, you expect US economy to recover to what it was during January, February 2022. So now we are going for a small pause. What we do, what we at Smart VRC do. Yes, I am the owner and founder of Smart VRC. We help investors create wealth from stocks smartly. How we help? And what is our performance? So this is a performance from a basket of stocks, which speaks everything about us, not only in terms of picking the stocks, but also in terms of the diversification, also in terms of patience, also in terms of properly managing the funds. We have never asked for additional funds. We have never sold anything. We have always remained 100% invested during last 21 years. And during last 21 years, investment of 1 lakh in this basket has grown to 1.37 crores. As on date, it is 137 lakhs. So it is 1.37 crores. This is data for 23rd August. Even today, its value is around 1.37 crores only. And this performance is way better than rest of the worldwide indices, including BSE Sensex of 16.12 and 15.31. The same basket that is known as SBP, that stands for Smart Billionaire Picks. Market capitalization, in terms of market capitalization, 38% are large cap, 21% small cap, and rest mid cap. This is the sector weightage. As you can see, it is highly diversified, not only in terms of the weightage, but also in terms of the number of stocks. the business groups also. So 75% are growth stocks and 25% are value stocks. Yes, finding the worth of a growth stock is much easier than finding the worth of a value stock. Also, the returns associated with value stocks are highly uncertain. So our mission is to share knowledge and wisdom and provide advice. This we do via website, mobile app, webinars, seminar, workshops, social media, television. Yes. Like the present one, what you are saying, it is a totally free, and this is being viewed by about 600, 700 investors. If you want to have a look at the past webinars, you can always visit our website, and under Smart Academy, go for Smart Insights. There you can select the category, and all the past webinars are present here. So we also can help you also for becoming a smart investor. Yes, smart investor means with the same amount of risk, we try for higher returns. Yes. So we provide advisory services under which we have 3 products: Smart Gains, Smart Multibagger, and Smart SIP. Also, we have videos with the name of Smart Insights Pro, and these videos are categorized under 4 groups, that is financial freedom, equity research, portfolio management, and controlling emotions. Yes, I am an author of the book Way to Billionaire. It is available in English as well as Gujarati. If you want to purchase, you can visit our website. Also, we have financial freedom calculators from which you can find out how much more investment you need to do based on your risk profile. For that, you can visit smartvrc.com. How we are different and in fact better. We have got a cumulative experience of 71 years. We have the ability to find the worth of the stock with good accuracy. Try to understand, without finding the worth of the stock, it is as good as playing stock market in dark. You do not know what is happening. Just because of the direction of the market, you may be making some profits, or maybe the direction of the stocks also. Yes, we are truly qualified, not only in terms of the experience, but also in terms of the qualifications. Every advice is closed loop advice. So whatever buy advice you will receive from us, you will also receive a sell advice, corresponding sell advice. And all these advices are sent through multiple channels, so there is no chance of missing. We send you WhatsApp, we send you email, and also we send you instant notifications on our mobile app. Also, we provide the weightage and allocation so that you are very clear that how much you should invest in a particular stock. All advices are made during the ruling price, during the market hours at the then ruling price. So this was all about Smart VRC. Now we are going to have number of slides, and I have tried to help you understand how inflation impacts the company's performance in a very simple and effective way. Yes, there are 2 companies. Consider names are A and B. Both have same products, same revenue, dividend payout policy is also same, and equity capital is also same. The only difference is company A is cash rich and company B has same amount of debt. So whatever the amount of cash company A has, the same amount of company B has a debt. Now, and it is, I have tried my best to keep it practical. Nothing like that A has 10 times of its revenue as cash, not like that. And we assume that the company A has made fixed deposit of its cash. So here is the impact of inflation. That is the topic. Here are the 2 companies. Revenue is 5,000 crores. Other income in case of A is 100 crores. It is because of the fixed deposit company has made, and company has earned interest of 100 crores. So naturally, maybe about 1,000 crores company has got cash. In case of B, no, there is no such income because company is debt ridden. Company has a debt, so it cannot get interest, it cannot earn interest. It has to pay interest. And because we are assuming that the same amount of debt as for B as for the same amount of cash for A. So interest paid is 100 crores, depreciation is 100 crores, tax is 75 crores for both. Profit after tax is 200 crores, equity capital 50 crores, EPS is 40 because profit after tax is same, equity capital is same, dividend is same because the policy is same, and PE ratio is also same. There are many assumptions, of course, but the purpose is not to go into the exactness, but to understand the implication of debt. And share price is 1,000 rupees. So P ratio is 25. 25 into 40 is 1,000. So this was all about A and B. Now what happens? After inflation, or rather when we should say due to the impact of inflation, what will happen? Presently, of course, with high inflation, there will be lower demand for the products, but for the time being, we have considered that there is no impact of demand and demand remains robust, but inflation is high, as presently in India also, as you must have seen. So other income, now the rate of interest has increased by 40%. When I say 40%, that means it has increased from 5% to 7%, right? It is a 40%. So since the rate of interest has increased by 40%, this will be other income for A will be up by 40%. For B, there is no impact, but okay, there is some, it has been wrongly mentioned as 600. It should have been 140. We'll take care in the next slide. Then depreciation is same, 100. Tax, not tax. What will happen to tax? Because this company has earned more income, this is taxable. So it will pay, instead of 75, it will pay 85 crores as tax, just an assumption, as I said. Out of 40 crores extra, 10 crores it has paid tax. That is tax bracket of 25%. And here it will have to pay lower tax because the company has paid more interest. It is not 600. It must be 140 crores here. Profit after tax, in this case, it will be 230 crores. Here it will be 170 crores because here 30 crores are extra, right? 40 crores extra plus 10 crores it has paid tax. So remaining is 30 crores. Here the impact is the other side, 30 crores less profit after tax. Equity capital is same. EPS will become 46 and here it will become 34. Now comes to the dividend. Dividend here will fall down to increase to 92%. Here it will fall down to 68%. Dividend policy is same. Policy in the sense how much dividend they are declaring. Here profit after tax was 200 and 80% they are declared. So that is about 40%. Same here also. P ratio, what will happen to the P ratio? Now, because this company is debted, okay, that was here also, but still the P ratio was same. Now what will happen is profit after tax is increased to 230. Earlier, so better it would be if we go by EPS. EPS is increased from 40 to 46. So despite slowdown, despite high inflation, I should not say slowdown, despite high inflation, EPS increased from 40 to 46 in the case of A, while in case of B, EPS has declined from 40 to 34. Instant reaction would be more confidence on stock A and hence increase in P ratio, less confidence on B because the rate of interests are still rising because the inflation is still going up. So here the confidence level will be low. So P ratio falls from 25 to 20, while in case of A, P ratio increases from 25 to 30. What happens to the share price? Here is the share price impact. From 1,000 rupees, it will increase to 1380, while in case of B, the share price will decline from 1,000 to 680. Now you will appreciate that what has happened. Basically, same revenues, everything is same just because of because of the reason that the company B has a debt, it has underperformed. Okay, its profit after tax is under pressure. Dividend is also under pressure. It may not be able to continue with this dividend policy. And so P ratio has fallen. So two things have happened. EPS has fallen down, that is okay. P ratio has also fallen down, and that is why the share price is down from 1,000 rupees to 680, that is about 32%, while here the share price is up by 38%. If you see the difference, it is 100%. That is the impact of high inflation, which in turn leads to high interest rates, and that is the difference. So be very careful. Don't have highly debted companies in your portfolio. Okay, this is for FY23. This was the actually this chart for FY23 I have repeated here. What next? What the company A will do and what the company B will try to do. Can you write in the chat box? What do you expect company A to do now? Considering that both are fighting neck to neck in the market, both have the same revenues, what would be the action by company A and what would be the action by company B? Please write in your chat box. Yeah. A will do expansion and increase market share. A will try to increase market share because it has got cash, because its earnings are up. Anything else? Okay, A will do buybacks. Why A will do buyback? Because its share price is already up. Okay, maybe because you are looking at this has got money and A expects its business to go up, the profitability to go up in the coming year. So A may opt for buyback. That is also a possibility. B would be trying to repaying debt. But B does not have, its profitability is declining. It may try, means it has made a profit of only 170 crores. So, and there is a depreciation component of 270 crores. And a lot of money is required for working capital also. Even if it tries, the impact on interest cost would be pretty low. B will liquidate or issue bonds or take loans. If it takes more loans, it will have to pay more interest. So its profitability will be impacted. But that is one of the recourse, because if it has to maintain its market share, maybe it may opt for that. Or quite possible B is looking for reduction in interest rates in coming 6 months or 1 year, and it may go for interest debt, maybe. So these are the various possibilities what investors you have written in the chat box. I think there was one more option. B will dividends. B may cut dividends. Yes, very much possible because it wants to conserve money. May try to reduce the price of its products. A. Yes, it is very much possible because it knows that its closest competitor is undergoing a pressure on profitability. This company B cannot try to reduce the product prices, so A can try to reduce the product prices. It has a buffer of money also with it in the bank of about 1,000 crores. It can afford to reduce B, knowing that B cannot reduce. So at the cost of this thing, A may try to grab more market share, and by reducing the price, it is possible that it may increase the revenues and the net profit after tax may remain same or even increase slightly. It is very much possible. It is a volume game. May go for expansion or acquisition. Yes, because A knows that B cannot undertake expansion. It would be very risky for B to go for expansion. And A has the money. A has increasing profitability. It can go for expansion or maybe acquisition. Also, there is a possibility for A to collect good sum at high share price, and it can fund that expansion instead of using the cash available in the bank. And B has a very low share price. If it tries to come out with a placement of shares, then it would expand its equity by good sum, good amount. So this was all about the two companies. Now, I hope you are able to appreciate the effect of inflation. Which are the promising sectors in the today's scenario in the domestic market? This we have discussed in the previous webinar also. One is auto related. I'm not saying specifically automobiles, OEMs, but auto related means which are directly or indirectly related with the auto OEMs like auto ancillaries, but in the domestic market. Cables, these companies are doing very well because the raw material, almost all the raw material prices are under free fall. Then banks and NBFC, because as you have seen, the GST is robust and high interest rates are always favorable for banks and NBFC. Construction companies, there are limited companies, but there are good options, good choices, couple of good stocks. Defense, you know very well. Infrastructure and housing related, the same as auto related. We are not talking about directly the housing companies, but real estate companies, but the indirect participants like paints, cement, there are furniture, that is MDF, ply. There are many options, or not, I should not say options, but many other companies or sectors related with the housing related demand. So as we have discussed, one is the avoid high debt companies. Second is strictly restrict the weightage of diversified export sector to just 15%. Why 15%? Because I'm not advocating that you totally sell all the export oriented stocks. You should have some exposure, but reduce it to about 15%. Focus on select domestic sectors, as we have already discussed, and remain invested. Yes, there are investors who think that presently markets are at high level worldwide, the markets are falling down, and our market will also fall down. So sell partly or sell totally now, and we will buy later. Maybe strategies may differ from investors to investors, but what we have experienced, our wisdom says that remain invested 100% all the time. You can make the changes as we have advocated in the top 3 points. You can make suitable changes in your basket, but don't sell just because you think that the market is going to fall, because it is just not possible. Moreover, if you have purchased some stock from long-term perspective and you are looking for only 3 months or 6 months perspective as far as the market is concerned, then there is a mismatch. Coming to the smart word, inflation is taxation without legislation. What does it mean? In case of income tax, there is a legislation. Thus, yes, we have to pay such and such income tax in such and such bracket. But when it comes to the inflation, it is same and one for all. I will give you an example. Before COVID, I used to pay 60 rupees for my haircut. Post COVID, now rates have increased to 125, almost doubled. It is doubled. So it is inflation. This is the inflation. For the same amount of money, I am not able to get the services which I used to get at the pre-COVID in the simplest form I have explained you. Yes, if you are interested in such webinars, in time to time, we also come out some blogs. I write articles also in newspaper. All these things I share in my various WhatsApp groups. So if you want to get the free inputs, you can always write us. Those who are not getting, those who are new rather, or you can even forward to your friends. You can write the name of that person, the city, and this is our WhatsApp number. Those who save this WhatsApp number will only receive the notifications. So once again, I am repeating it: 9755920780. So now we are heading for question answer session. Thank you. So you can write in the chat box if you have got any query, or you can raise the hand. How defense sector can outperform in current scenario? As the government is focusing on the Atmanirbhar theme, and government is trying to reduce imports as much as possible. You must have observed that our major export, our country's major import items are crude oil and defense. These are the major pie among the total share. So government is trying to reduce the dependence, and defense can help you. Defense can help us to defense sector can help us to reduce our dependence on imports. How do you expect the fertilizer sector? Okay. In case of fertilizer, as well as in case of sugar, a lot of things are under control of the government. So normally, we do not advise to invest in these sectors unless until there is some very strong case. Otherwise, don't invest, because what the government will decide in terms of pricing, no one knows. So there is a lot of uncertainty. You cannot project 2 years or 3 years hence what will happen. Any views on highly leveraged renewable stocks? Should we stay invested or exit now? I have given you a very fairly good idea about the impact of high interest rates. Now, rest is up to you. Means if you are confident, that the company will be able to generate a strong revenue and profitability stream in times to come, you may continue. Otherwise, it is better to stay away. Your views on tier one IT companies. See, with the slowdown in US, all companies will suffer. So I would, as I said, the total export-oriented stocks should not form more than 15% allocation or weightage in your portfolio. Infra construction companies heavily capitalized. So there are companies which are not capitalized. You can look for them. It is not necessary that all infra and construction companies are highly leveraged. Any plan for online workshop? Sorry, we are not able to finalize it. Yes, we very much want it to have an offline workshop, but as and when materializes, we shall inform you. Online workshop we are not going to have. Views about chemical sector due to demand from China or rest of the world. Yeah, China, as we all know, pre-COVID, China was a major player in the chemical sector worldwide. But now, most of the countries are looking for a substitute or China plus one policy, and that is why India has a strong case. Indian chemical sector has good prospects. Recently, Morgan Stanley downgraded chemical companies. Please share your view. There are many a times such big institutions make certain predictions, and you find that within a month or two, those predictions go wrong. So it is up to them. I don't know on what basis those predictions have been made and for what duration, maybe in the midterm, short term, or long term. Your views on paper sector. For paper sector, I will request you to go back in the pre-COVID area, maybe in terms of January, February 2020, and compare these prices with today's prices, and you will find that most of the company stocks are up by more than 60% or 70%. Moreover, in paper sector, the demand growth is very low, maybe about 4 to 5% only. So be very careful. So these were all the questions, and anybody who want to ask can write or you can raise your hand. Auto sector we have already discussed. Go for auto ancillaries rather than auto OEMs. Last time when crude prices were low, we took advantage by investing in footwear and packaging sector. Yes, very well. I remember Relaxo footwear and many packaging sector companies, Cosmo Films, Polyplex, many companies. We have made multiple returns. These sectors present good opportunity, but be very careful, especially with the packaging companies, because most of these packaging companies are export oriented, and demand slowdown is, yes, very much there, imminent, and rather I should say not imminent, but already visible. So any other query? So with this, we have come to the end of today's presentation. I thank you very much for sparing your valuable time on Sunday, a holiday, and being a festival season. Thank you. Thank you very much.